Okay, so happy to be here again, as always. I'm always happy to provide information session where I provide insight as to how best as Canadian residents to make the best out of our tax situation. There are two things that are sure in life if you live in the Western world: debt and taxes. Right? So um, even in our journey as we're trying to maximize wealth, make us want to stay financially independent, one factor that we always have to consider is taxes. If you're making any decision, be it business decision, you have to consider taxes. So no wonder this presentation is titled Personal Tax Saving Strategies, because tax strategy has to be personalized. It's not generic. You can't say, oh, can you help me with a tax strategy? For someone to come up with a strategy, you have to understand the individual situation. So that's why tax strategies are always personal. Even though they're personal, doesn't necessarily mean that it might be a combination of uh, different approach you would take. For some people, their strategies might be similar, might be the same, but still, we'll still call it a personal tax strategy. Now, to start this presentation, I would like to identify what are the ways that the general pillars, so to speak, of optimizing your tax situation. So I would say there are three main pillars. Three main pillars. There are more, but these are the three main ways in which you can optimize your tax situation. The very first way is having as much deduction against your income. That's the first way, meaning that if you earn income, you want to be able to um, apply deductions against your income so that your taxable income uh, is near zero, so to speak. The second pillar is see how much tax credits you can get. And the third pillar is deferring your taxes. Now, those are the three main pillars. There are other pillars, there are other strategies people adopt, um, which are a bit more complex, which we will not talk about in this forum. Now, but I will try to address two of those pillars. And the first pillar is tax deductions. So the question you ask is, what are tax deductions? And I'm going to start off by saying tax deductions versus tax credits. What are they? So tax deductions simply means what eligible expenses or deductions that you can take away from your income. Tax deductions basically reduce the amount of income that is subject to taxes. Tax deduction lower your taxable income, which in turn reduces the amount of taxes you owe. So what tax deduction does is does two things. One, it can not just only reduce your income, but take you from one tax bracket to another tax bracket. As you're aware, Canadian tax system is based on it's not the taxation rate is not fixed. It is based on your income. So those are the lower income brackets. Their tax rates are lower. As you go up that scale, your tax rate increases. So when you have a tax deduction, one thing is that it's not just only reducing the tax base, that is the taxable amount, but the other thing it does is that it even the tax rate that will be applied might even change if you have a tax deduction. So that's why tax deduction is one of the very effective ways of maximizing your tax position. The benefit of tax deduction depends on your tax bracket. A higher income earner gets more tax benefits from a tax deduction because they are in a higher tax bracket. Now, on the other hand, tax credit reduces the actual amount of taxes you owe, even without applying the tax rate. So a tax credit is applied after tax has been calculated. So a tax credit is um, it's applied against the taxes you owe, and a tax credit can actually result into cash entering your pocket. And it comes in two forms. The tax credit can either be refundable or non-refundable, and I'm going to explain what that is. And the reason why I'm trying to explain it so that you can understand how you can apply all of these concepts when it comes to maximizing your tax position. Now, the tax deduction, as I said, reduces the amount of income that is subject to taxes. We talked about that. It lowers your taxable income, and it can take you from one tax bracket to another. Now, I'm going to give, before I delve into the difference between refundable and non-refundable tax credits, let me explain what tax deductions are. So, for example, an RRSP is a tax deduction. An RRSP is simply retirement savings plan. So, if you contribute into a retirement savings plan, that contribution can be deducted from your income. So, let's say you earn $100,000 in a year, and you contributed, say, $50,000 into an RSP that year, and that is within your contribution limit and deduction room. It'll be 100,000 minus minus the $15,000 you contributed to an RSP. So the taxable income is not 100,000, but will be 85,000. Now, anyone who earns 100,000, your tax rate, you're in the tax bracket where the tax rate is 33%. Coming down to 85,000, you notice that you come to a lower tax bracket at the federal level of about 26%. So you can just imagine the impact that will have. The tax rate reduces, the tax rate also reduces. Another example of tax deduction is union dues, union professional dues. So professional dues such as if you're a member of CPA, CPHR, you are a pharmacist, a doctor, a lawyer, you are required to maintain a license to do your work. Those professional dues are deductible. Childcare expenses. If you had to take your child after school service, uh, or the daycare service, summer camp, winter camp, whatever camp at all, you can deduct your childcare expense. So, as an example, you have two kids who go to daycare, you pay $500 monthly. So in a year, that's $6,000 per child, and you have two children. So what it means is 12,000 it can be deducted from your income. So using that example, you earn 100,000 minus 12,000. So the taxable income is no longer 100,000, but will be 88,000. Moving expense is also another deduction. If you move 40 kilometers closer to for a new job or school, you may be eligible to deduct moving expenses. So you move from Calgary to Edmonton, even if you move within Alberta, let's say you move from Sherwood Park to Edmonton, and it's more than 40 kilometers because you got a new job, yes, you can claim your moving expenses. Moving expenses such as travel, you had to sell a house in Sherwood Park, the legal fees, all of that can be written off. The commission you pay to realtor, that are eligible moving expenses. Just to mention a few. Now let's go to understanding tax credits. So tax credits, as I said, help reduce the actual amount of taxes you owe. They are applied after the tax has been calculated. Now, the tax credits, as I mentioned, they can either be refundable or non-refundable. Refundable tax credits can result in a refund if the tax credits if the credit itself exceeds the tax owing. So I'll give you an example. So an example of a refundable tax credit will be okay, let me not give an example, but just for clarity, refundable tax credits can result in a refund if and only if the credit exceeds the tax you owe. Now, for non-refundable tax credits, they can reduce your taxes owed to zero, meaning that if it's a non-refundable tax credit, the maximum so if you have a credit of 2,000 and you have a tax owing of say 1,000, the credit is more than the tax owing, right? So you can only use that credit to reduce the tax owing It can only reduce it to zero, but it doesn't result in money entering into your pocket. Now, with the example I'll give, you will understand it a little better. Now, what are the difference? Now, for environmental tax credits, just for emphasis, if the credit is more than the taxes you owe, the government refunds the excess amount to you. So if you have a refundable tax credit of $2,000 and the amount of taxes you owe is $800, the difference is $1,200. That $1,200 will go into your pocket. However, for a non-refundable tax credit, you owe 2,000, your credit is 1,002. You can only be, I mean, you owe 1,002. Your non-refundable tax credit is 2,000. You will reduce the amount your tax going to zero, and you forfeit the rest. You cannot carry it forward. You cannot utilize it past what you owe. Now, examples of refundable tax credits include GST or HST credit, which is paid on a quarterly basis, and that's typically for low-income earners. Another is the Canada Workers Benefit, which is also meant for low-income earners. And then there's also the refundable medical expense supplement, a credit specifically available for low-income earners with high medical expenses. Now, for a non-refundable tax credit, the example will include your basic amount. Your basic amount is everyone gets that. The basic amount for last year was 15,000, right? And that you get, everybody gets that, right? However, 15,000 up until if your income once you cross an income threshold of 165,000, then that non-refundable tax credit reduces. Another example of non-refundable tax credit is the medical expense credit for eligible medical expenses. Another is your tuition tax credit if you went to school, like when I mean school, like a post-secondary school, university, you went to do a postgraduate study. That's that's where you get a tuition tax credit. Example of refundable tax credit, we've highlighted that already. An example of non-refundable tax credit is what you can see on the screen. Now, a unique one is the disability tax credit for anyone who has a disability. And when we say disability, for example, it might interest you to know that if you have diabetes, as an example, or you're diabetic, you can qualify for disability tax credit. All you need to do is to fill out the T2202, sorry, a T2201 rather, and have it signed off by a medical practitioner. And with that, you can send it off to CRA. You get approved, and you can get that tax credit. Now, the key differences we've noted already is how it works. Tax deduction lowers taxable income. The impact, higher income earners benefit more from deduction. Tax credits typically help low-income earners, and tax credits help all taxpayers equally regardless of their income. However, tax credits usually are targeted to low-income earners. Now, let's now go a little further. Now that we understand the concept of tax credits and deductions, let's now go into some of the nitty-gritty. RSP contribution is what I mentioned. I mean, if you're RSP contribution ties to the third pillar of the tax strategy I mentioned, which is tax deferral. Now, RSP, although what happens is you use the RSP contribution to reduce your taxable income, but note, you are deferring that tax. So at the end of the day, you're still going to pay the tax. But the question you ask yourself, why am I deferring it? Yeah, although I'm enjoying the benefit now and then I'm paying less taxes, but does it make sense for me to defer the taxes? The answer is it depends. It depends on your situation. Now, there is a there can be you can actually have there is a relationship between our age, for some of us, not all of us, between our age and our earning power. Now, you will agree with me that the younger you are, the more economic power you have in generating wealth. Now, and as I said, this doesn't apply to everyone. It doesn't apply to the general population, but there is a genuine relationship between our age, and our earning power. So what that simply means is that when you're active under 65, you have that earning power. So you're earning now. So your disposable income or your income you earn is higher. And then as we age, when we get to retirement, it is most likely for most of us that our income will drop. So if our income drops while we get older, what happens is we're going to be in a lower tax bracket compared to now that you're in a higher tax bracket because your earning power is higher. So if you find yourself in that within that group, it will make sense to want to defer your income, defer the taxes rather. Defer the taxes now, pay less taxes now, because you're going to be in a low, you're most likely to be in a lower tax bracket down the road, right? So that's an argument you can have when you think about your tax strategy. Another thing to be aware of when it comes to RSP, you can borrow from your RSP to buy a home. And then what happens is that what you borrow, you can pay it over 15 years. So that's also another strategy you can adopt. Put money in your RSP, borrow it, buy a home, and then over time you'll be spreading the tax burden. So that's also something you might want to consider. But however, just know that for RSP, there is limits in terms of how much you can contribute. It is capped at 18% of your previous year end income to a maximum of $31,560. Another strategy you might want to adopt is utilizing your TFSA. However, for tax filing, just note every TFSA contributions are not deductible. I'll repeat that again. TFSA contributions are not deductible. The only reason why we included, we're talking about TFSA is that your after-tax dollars put into a TFSA, any capital appreciation, any growth, any interest earned is not taxed when you want to withdraw it. So that's, so for some people, once you max out your RSP and you want to have after-tax dollars, TFSA is something you can also consider. And there's no age limit to it. We talked about medical expenses. Medical expenses can significantly reduce your taxable income. You want to track that. And taking note, medical expenses is capped at 3% of your net income. And it's a tax credit that is also capped at 50% of the actual medical expense. So I'll give you an example. Let's say you earn $60,000 and you have $5,000 in medical expenses. The first step you need to do is 3% of 60,000 is 1,800, and your medical expenses is 6,000. As long as the expense is greater than 3% of your income or of your net income, then you can claim it. That's step one. Step two, in claiming it, $6,000 in terms of the impact it has on you, it will be 15% of 6,000, which will be $900. That's the money you will get back in taxes if you actually pay taxes during the year. So you can get that money back as cash. So take note of that. Now, another thing is your charitable donations. So if you contribute to a registered charity, be it church, could be a foundation, those are deductible. How does that work? The first $200 is capped at 15%. Anything above that is capped at 29%. So I'll give you a theoretical example. Let's say you had say $1,000.
It's not. Go and bring your Chromebook.
So let's say you contributed
Because I'm in a
$1,000
timed out.
as donation. So 15% of 200 is $30. 29% of, or so I'll say 30% of 900 of 800 will be what? Roughly about 240, right? So 240 plus 30, so you're going to get $270 back as in taxes for that donation you made. Okay. Another strategy that people adopt is what's called income splitting, but this is more focused on if you so two set of people. One, for older folks who have pension, that's They can do income splitting to optimize their tax position, where a higher income earner from pension can move a part of the pension to the lower income earner. And then what happens is that they both go to a lower tax bracket. Other income splitting options include, for example, you could split an investment income through a T5 or a T3. That also can help reduce the tax liability if rather than one individual claiming that investment. Okay. I did mention tuition credits. So don't forget, if you went to school or even you took a course. So there are some courses that are eligible. For example, if you did a short-term course with NATE, SATE, you get a tuition receipt. You can claim those tax credits as well. And of course, there's also what is called the Canada training credit or training amount. That is something you can also get by claiming your tuition. Note, if you got a grant take note, if you got a grant to go for such studies, you typically get a T4A. Please and please, when you're filing your taxes, do not recognize your grant as taxable income if it was full-time study. So take note of that. And when we say full-time study, doesn't mean you're not working. You can be working and be doing full-time study. So take note of that as well. Some people get, like, maybe they got a grant, and the next thing you see that the grant is taxable. Please take note of that. If you need any guidance on that, reach out. Childcare expenses. Take note, you can deduct eligible expenses, including fees paid to daycare centers, babysitters, and after-school program. It's important to keep all your receipts and documentation. Also note that it's capped at 8,000 per child, right? So as you look for a daycare service or after school care, just note that you don't want to, if it's too expensive, then what happens is that some portion of it might not be claimable to a maximum of $8,000. So please note that, write that down, something to consider. I won't talk so much about capital gain or losses, but the only thing I just want to tell you, there's an update. So based on the tax bill, no, I won't say tax bill, like it was put in motion in the House in 2024 that the inclusion rate for capital gain should move up from 50% to 66.7%. So that's something to be mindful of. So if you sell a digital asset, you sell an investment, property, or any type of investment at all, it's now going to be subject to 66.7% inclusion rate. Okay. And inclusion rate simply means that, so let me use this example to explain what inclusion rate. So we're not saying it's going to be taxed at 66.7%. No. So let's say you bought a house for 200,000 in 2023 and sold it for 350,000 in 2024. Okay. Now that's example one. Now 300,000 in 2023 and 350,000 you sold in 2024. 350 minus 300 is 50,000. Good. Now, because that the gain you made is 50,000 is less than, there's a threshold you have. The threshold is any gain over 300,000 will be subject, the inclusion rate is 66.7%. So if you make a gain of 50,000, the inclusion rate will still be 50%. So what it means is that 50,000 divided by 2, which is 50%. So what will be subject to capital gain will be $25,000 multiplied by the effective tax rate. However, on the flip side, let's say you bought a house for 300,000 but sold it for 800,000. That means you made a gain of 500,000. So instead of applying 50%, you're going to apply 66.7% is the inclusion rate, then apply the applicable tax rate based on your tax bracket. Moving expenses, I think we talked about that already. In case you moved for work, for school, to get close to school, just know that you can claim your moving expenses. If you bought a home, if you're a home buyer, a new home buyer, you can claim what's called the home buyer's amount, which is $10,000, and then of course capped at 15%. So you can get $1,500 as a tax credit for buying a new home. FSHA is also something that is also something you can use in reducing your taxable income. That's the first home savings amount. Okay. There's also the home accessibility tax credit that if you had to change or modify your home because of the special need, maybe you have an aged parent living with you, and you have to modify your home to make your home more accessible, you can claim what's called the home accessibility tax credit. Now, other deductions that you need to be aware of. If you have a home office, that is, you work from home for your business, you can claim your home office expenses based on the what do you call it? Based on the square footage. Now, if the calculating the home office expense deduction, if you work from home, previously it used to be $2 per day up to 200 days. That is no longer applicable, although I put that on the slide, but that happened in COVID period. However, if you for your business, if you had to work from home, all you need to do is measure the area that you work from, your home office. If you measure the area, let's say it's 400 square foot, and the total square foot of the house is say 1,600, what it simply means is that 400 divided by 1,600, that's 25% of your rent, your electricity, your utilities, internet. It's what you can claim as home expense. And if you're an employee and you work from home, you will need to get a T2200 from your employer. And there is the CRA calculator that will help you calculate your work from home. So you're no longer allowed to use the $2 per day up to 200 days. Now, if you're sole proprietor, what do you need to be aware of? It's essential that you want to separate your business and your personal finances so that you can accurately capture your expenses correctly. And how can you do this? You want to keep things like a detailed log of if you had to travel, you had to go visit customer, make deliveries. You want to organize your expense records. You want to keep your receipts. You might want to have a workbook where you track all your expenses, whether utilities, travel costs, things like that. You want to keep it. Like you can also leverage software such as QuickBooks, Xero, FreshBooks. Those are good tools you can use. Home office allocation, I think I talked about it. I talked about how you can arrive at that and how you can claim that, so I won't touch on that. Deduct vehicle expenses. Now, vehicle expenses, if you own a vehicle and you use it partly for work, for business, it's good to keep a detailed logbook that can help track your business-related vehicle mileage. It's hard to have like a paper logbook. These days, you can have a tracker on your phone that can automatically track when you are traveling, the distance, the distance between the one place to the other, and at the end of the day, you can actually export that data into Excel or any soft copy and have a log. So something to keep take note of. And for your vehicle expenses, once you have that log, what you simply need to do is that log will tell you the travel that you did for business and the total travel you did for the year. So let's say the total mileage you put on your vehicle for an entire year was say 8,000 kilometers. You'll be able to tell, okay, 2,500 of that relates to my business. So okay, let me just say let's say 2,000 of that is relates to my business. So 2,000 divided by 8,000, that's 25%. So what it means that 25% of your insurance, of your fuel, of your car wash can be written off against your business. Okay. Claim for capital cost allowance is something you want to also be aware of if you had to buy computer equipment, machinery. Typically, you cannot write off all of that cost in 1 year. Rather, you have to write it off over a period. So what does that mean? So let's say you bought a heavy duty machinery that produces bread or produces something, and you bought it for 20 grand, right? So most likely you're going to have to write it off over 5 years. Because that's the prescribed CCE rate for that machinery. So what it means is that 20% of that cost will be written off in year one, year two, year three, year four, and then year five. So just take note of that. And the CRA has they have different rates for different capital assets. And lastly, what I'll just mention is in considering your tax strategy, even as a business owner, there are times whereby you might need to consider whether it makes sense to transition from being a sole proprietor to a corporation, because corporations typically have a lower tax rate compared to personal income taxes. So at this point, that's the end of my presentation. I will now leave it open. I would like to take as many questions as possible. Yeah, so let me know if you have any specific questions. I see some questions in the chat. So,
Yeah, we have questions in the chat already.
okay,
So maybe I read it out and then you can take them.
sure.
The first question is from Zion. Can funds be moved from the RRSP to a TFSA?
Now, if you do, you will have to pay taxes on that. So it's not like a direct transfer. You tell your bank, can you transfer this? You have to withdraw the money and then put it into the TFSA. But you will then have to suffer that tax liability. Usually, the banks subject it to 10% at the point of withdrawal. It all depends. There's a threshold actually. If you withdraw up to 20,000, they can subject that withdrawal up to 20%. And yeah, the direct answer to your question is there's no direct transfer. If you want to move the funds, you will have to withdraw it, pay taxes on it, and move it to your TFSA.
Zion, does that answer your question? You can give a thumbs up if it does, or you can expatiate on it if you want more clarity. Okay, let's move to the next question. As a mom, this is from CEO Chibo. As a mom of a 20-year-old in college, do I have to file her taxes or she can do that by herself?
She will have to do it by herself. However, take note that if she's doing it by herself and she pays tuition, right? She can transfer some of her tuition to you up until, I mean, the maximum she can transfer to you is $5,000. So if, for example, you paid her school fees and she's filing her taxes and she includes her tuition she paid, she can transfer up to $5,000 in tuition credit to you.
Um, okay, there was a second part to the question. So she's saying also what percentage of tuition is eligible for tax credit?
15%.
15%. Okay,
Yeah,
please, Mr. Rex, if you can just help expatiate more on what you just said. So the 20-year-old will file her taxes for herself.
correct.
And then what is the benefit of her transferring some tuition to her mom?
I mean, there's gratitude, right? If she wants to, it's her business. Like that's if the child wants to. If the child doesn't want to, there's nothing you can do. So the benefit is if you transfer that credit. So you can imagine 15% of $5,000. That's about $750 you get in your pocket, right? So
Oh, okay. So the credit room will be
yeah,
transferred to the parent, and the parent can claim
correct.
that.
So you
Okay.
can imagine if she paid school fees of say 15,000, right? And she transferred 5,000 to her parent, she still has $10,000. So she will get the benefit of the $10,000 tax credit
Mm-hmm.
as a student, but then that 5,000 transferred to her parent, she can now that she can apply, her parent can apply the tax credit when they're filing their own taxes.
Okay, just to piggyback on her question. So what if the child is using, like, is paying her tuition using the funds generated from an RESP? Can they still claim tax credit for
Yes,
that?
100%, yes.
Okay, okay,
Yeah.
okay. Thank you. I don't know if you're cleared with that answer, Ochibo. Okay, let's move to the next
Yes,
question.
yes. Thank you.
Okay, thank you for answering. Will the recording be, yeah, it will be sent out. You just give me a day or two to just do some things and I'll send out the link to watch the video. Um, Now, this other question is from Olu Busayo. Please don't mind me. I'm from Benue. If I murder your name, I'm sorry about it. Just bear with me. So his question is, I work hybrid, 3 days at home, 2 days in the office. What can I claim as home expense?
Okay, so you know what I'll do to make it easy? I will CRA. Just give me a second. I just want to share this on the screen so that I can. Okay, so let me share my screen because it's easier to explain directly from the CRA website. So let me know when you can see this.
Yeah, we can see your screen now.
So it's called a home office expense for employees. So rule number one, you must work at least more than 50% of the time at home for you to claim work from home expense. So 3/5 is 60%. So that's good. So what year are you claiming home office expenses? 2024. Then it says, given the various types of expenses, the calculator, blah, 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 blah. So now before you continue, make sure of the following. One, confirm that you meet the eligibility criteria for the detailed method, which I will open up. And the criteria, the eligibility include one of the following. One, to claim the actual expenses you paid for working from home, you must meet all of the following conditions. One, the employer required you to work from home. Two, you were required to pay for expenses related to workspace in your home. Three, which I don't mention, you worked more than 50% of the time from the workspace in your home for a period of at least 4 consecutive weeks in the year. Five, your expenses were used directly in your work, and you received a form called T2200. Now, once you meet that requirement, then we can go on to the next question. What is your residence situation? Either you rent, you own, or let's just say you rent, right? Do you have a designated workspace? Yes. Do you know the square footage? Yes. Let's say you using that same example, the square footage is 400. Your entire home is 1,600. You can claim 25% as I mentioned. Start date 2024 2024 01 01 12 31st for the entire year. Let's say you pay $2,000 every month, so 24,000. Let's say you pay $100 every month for heating and whatever, so that's 1,002. And let's say maybe you did want special cleaning, $200. So, and let's say that's that, and calculate. So using this example, you can claim $6,350 as work from home expense. Does that answer your question?
Yes, thank you very much.
Yeah.
Okay.
Okay, awesome. The next question is from Zion. As an
Sorry, can I just ask a quick question before you?
Please, please.
What if you are a self-employed? Does this apply to self-employed
So
as well?
self-employed, no. What I showed you is specifically for employed. For self-employed, there are no rules on that.
Okay.
Yeah.
Okay. Next question is from Zion. As an independent consultant, what tax deduction am I eligible for? So I'm sure it's almost what Madam Ochibo is trying to ask.
There's no, how do I put it? It's personal, but I can give you generic examples. You're Uber, you traveled to Ontario, you traveled to Manitoba for business. Those are eligible deductions. You had to buy You have to buy a computer, you have to buy software, you have to subscribe, where you can do research. Those are eligible expenses. You pay your accountant, you pay your lawyer, you pay an advisor. Those are expenses. You use your credit card, and the credit card got charges. Those interests, they're valid business expenses. Your
What
bank
about stuff like
charges.
lunch? I ate lunch at work.
Lunch is, if it's a business lunch, yes. Not say in the evening you gather your friends, family and friends, and go and start eating. That's not deductible. Yeah,
I'll start eating lunch out every day with my family.
yeah. So those are generic examples.
Mhm.
Then let's say your licensing, insurance for liability, E&O, error and omission. Those are business expenses.
So, in a nutshell, anything that you're doing that costs you money and you're doing it because of your business, you can claim as
Exactly. So the
your.
rule is you must be able to demonstrate that that expense is necessary for you to generate income. If there is a if you can demonstrate there's a correlation between expending that funds to be able to, like for example, you're going through someone who will help you get a bit to win a business, and you have to pay commission to that individual. That's a business expense. Like, and you can demonstrate that you got that commission. Yes, that's a valid expense. You went for a business meeting and you had to buy lunch for the client to discuss, and you got the, yeah, that's a valid business expense.
As long as you can prove it, because
Yeah, as
sometimes
long as you can prove it. Yeah,
if you don't, even if it's a business expense and there's an audit and you can't prove it, you can get into trouble. So if you have all your
yeah.
receipts, make sure you keep all your receipts. I think you have to keep them for, like, is it 6 years or
Six
5 years?
6 years.
Yeah.
6 years. Yeah.
So put that into consideration. Okay. The next question is from Ikena. For us newcomers, unemployed, are we expected to file our taxes, and what are we filing?
Okay, newcomer. Yeah. So as long as you're a resident in Canada, employed or non-employed, you expect to file your taxes. Now, if you don't, if you don't do it on time, you don't get penalized because you don't have a tax liability. So penalty is based on, oh, if you have a tax owing, that's when you get penalized. Now, but the benefit of filing taxes, even if you are unemployed, meaning that you're just only filing and declaring that, oh, I didn't make any income. The benefit of doing so is you'll be eligible for certain benefits, such as the GST credits, as I mentioned earlier, or you will be eligible for the carbon rebates. So those are the benefits for filing taxes. If you are new and you have a child and you don't file taxes, you're not going to get the CCB, the Canada Child Benefit. So that's the benefit of filing taxes, even though you don't have income. Your question is, what are you to file? You're not like you just write. You're just pretty much putting your name, your SIN, your house address, email address, phone number, and declaring that, oh, I'm in Canada, I have zero income. That's all.
Okay, can I ask a question regarding that?
Please go ahead.
Okay, yeah, I'm in Canada, I have no income, but one of my expenditures, like my expenses, obviously I've been paying bills and all those things. Are they taxable as well?
Nah, you pay bills. Bills are not taxable.
Okay,
No, you don't have to report bills you paid. No.
okay, okay. Thank you.
Yeah.
Okay, to the next question. Okay. If I am a living caregiver for my employer, can I claim work from home expenses? Work from home
So when you say live in home caregiver, are you living in the house of the person you are taking care of, or the person you are taking care of is living in your own house?
Um, this question is from Omo. Please, can
Yeah,
you?
living with employer.
You're living with your employer. The employer is the one
Yes.
who owns the house. So what are you claiming? You're not paying anything now.
Phone, phone
No,
bill.
no, no, phone bills. No, 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 that's not. So the phone bills, the phone is for personal use. It's not as if your employer mandated you to have a phone so that you can be making calls. Like, yeah, like the phone is more of a personal thing. Now, if except you, the argument is if the employer says, "Oh, um, you need to be making calls and use your personal phone," the employer has to give you a T220, a T2200, saying that as part of your employment contract, you are supposed to use your personal phone for the work. Then you can claim your phone bills.
But Mr. Rex,
All right, thank you.
what if she's like an employee? Oh no, not an employee. She's like a contractor. So she's self-employed, but she's working for someone. I don't know if what I'm saying makes sense. So she's
Yeah,
not
if
like
she's
an employee.
so if you self-employed, that's a different ball game. Self-employed, there are no rules to self-employed. You
Yeah.
can claim you can claim your phone. But if you have an employment contract and you have a T4, T4, not T4A, T4, you cannot claim those expenses except your employer gives you a T2200. So to be clear, self-employed, the rules are fluid. There's no rules at all on that.
Okay, so Omo, are you self-employed or are you employed as an employee?
Um, Employed as an employee. So sometimes I use the phone for my employer to make calls, in the course of duties. So that's
So
why I'm asking.
request your employer to fill out the T2200, fill
Okay.
it out, stating that as part of the employment contract, you're required to use your personal assets to do her job.
Okay. Okay.
Yeah,
Thank you.
you can
Thank you.
you can get that form online. Just fill it out. All she needs to do is just sign it off.
Okay.
Yeah,
All right. Thank you.
yeah.
Okay, the next question is from Samuel Ope. What is advisable to file taxes if one is a sole proprietor also also how to file his personal tax from paid employment?
So if you work too hard, meaning that you're self-employed as a sole proprietor and you also get a T4, you don't even have an option. You have to file it as one because you and that business is seen as one and the same. You're not different from the business. A sole proprietor, from the eyes of the law, is seen as that individual, even if it has a name. That name is just an alias. It's you, right? So when you say advisable, there's no advice here. It's you have to file as you file your T4. You also have to file your self-employment, your income as a sole proprietor. You report the income, report all the expenses. The net is what is now added to your employment income and then taxed.
Yeah. Mr. Samuel, I don't know if that answers your question. Is Mr. Samuel? Yeah, okay. Okay. Um, are there any other questions that need to be clarified? Any other questions? It's like everybody's a tax guru here, so we don't have too many questions to ask. Okay, so let me just ask, like,
We're
you
not
mentioned.
tax gurus, though. It's just that we're newcomers, so we're still not very clear on how the whole process works. This is going to be the first time. So with
Okay.
for somebody like me, I'm trying to figure it out in my head.
Don't worry, it's not so difficult. Are you an employee or do you work
I'm
for?
employed.
Sorry?
I'm employed.
Okay.
Yeah, employee, yeah.
Okay. So I don't know if Mr. Rex, if you have time to just show what it looks like to put in a very simple tax, Is there any way you can do it? Because there is no T4 or anything for you to use, right?
Yes, there's no T4, and it would take, I think it would take another session to do that,
Okay.
where, I mean, I would like hands-on. I would tell them, oh, this is the software you can use, like TurboTax, login. It's it's going to take, like, if I'm going to do it in 5 minutes or 10 minutes, I'll breeze through and they will be lost.
Lost.
Right? I can really do it in 10 minutes, but honestly, for the
It
first
costs more
time,
harm than good, right?
exactly. So we can maybe have another session the upper week, not next week, the week after, and I can use 30 minutes to demonstrate how the how to do it.
Okay, so what is going to happen? I'm going to be like maybe calling you guys later in the week, and depending on what answers I get, the poll, if I have enough people that are willing to come for a 30-minute session for Mr. Rex to show what it looks like to file, especially for the new guys that are here, then we'll beg him and ask him to come. But that's for very simple, if you have a very simple tax situation. If your tax situation is a bit more complex, you have a business, yeah, you have a, you would have to reach out to him and you guys have to work on that on a personal. But for very simple, for maybe someone like Ikena that has zero in income, right?
Hmm.
But I have to have like at least 7 to 8 people willing to come, so I don't take a chunk of Mr. Rex's time and then nobody shows up for the meeting. So I'll be calling you guys during the week to plan that. So I think another question dropped in. Sorry, Mr. Rex. I know we're almost out of time, but please, if the sole proprietor becomes an incorporation, what's the benefit?
So the benefit would be, as I said, the tax rates for a corporation is significantly lower than that of a sole proprietor. That's just a summary of it.
Okay. Was there another question? Thank you. Okay, that would be nice. Thank you for enlightening. Okay, I don't think, did I miss any question? If you had a question and I didn't read it out or anything, please, we have 2 minutes before we let Mr. Rex go. Okay, no other questions. So I want to use this opportunity to say very, 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 very big thank you to Mr. Rex. Thank you for coming. Anytime we need him, he's always showing up for us. And he's not being paid for this. He's just taking out his time to do this for our community so we don't end up making mistakes. When, especially for us that are new, right? We don't make mistakes. So we give Mr. Rex a very, very big thank you. And another thing, I'm going to be sending out his complimentary card in the email I'm going to be sending out when I'm sending out the links for the recording. He's also a mortgage broker for new guys or people that are trying to get their new homes. Please, Mr. Rex is the man to talk to for your mortgage. He will help you out with your taxes and also give you a good deal for your mortgage. So that's like a win-win-win for everybody. Thank you so much. And over to my co-host, Grace, if you just have 1 or 2 things to say to us before we round up for today.
Hello, everybody. Thank you once again for coming for this session. I hope you learned a lot. You know, for me, it's always an eye opener every time I attend my sessions. All right. Okay. Thank you very much, Mr. Rex. Thank you very much for coming, and see you all at our next session.